David Morgan of themorganreport.com is an expert on all things silver. Unless you're new to the channel, you will probably have heard one of David's many appearances with us and his forecast on silver in the past. David, welcome back to the show.
David, thanks for having me.
Always a pleasure, David. Now, let's talk about your outlook for the silver market for 2022. But before we give your year-end forecast, let's talk about what's happening with the markets today. As we speak on Monday, rough day for equities. The S&P 500 is down 1.4% as of 9 a.m. Pacific time. And it just seems to me that there's a lot of fear in the markets. Gold and silver are holding steady, though. They're not rising, as you might expect a safe haven to, and they're not falling as you might expect all assets to be selling off during a fire sale event. So what's going on right now?
Well, we're seeing a divergence, and I think the long-term trends are in a position of changing, meaning that the equity side's probably going to see lower prices over the whole year, generally. And then, of course, the metals are, especially gold, is the most negatively correlated asset. But one day doesn't make a market, and a large sell-off. And this is the number one question I get all the time. If there's a stock market crash, what do gold and silver do? And the answer is they go down with the market. But they're the first to recover and come back. The 2008 financial crisis is a perfect example. If you're worried about a stock market crash, go back in history and look at some charts of what happened in the real estate market, and the stock market, and the gold and silver markets, and you get a good idea. Silver, for instance, bottomed around $9, but the actual demand was so strong that places even like Kitco were selling, I'm not saying quoting exactly right, David, but a lot of dealers were quoting $13 silver when the paper price was $9. You could have bought it at $9. I actually bought some COMEX bars and had them minted in the coins. Anyway, the point is, at that bottom, which was the best time you could buy it, went from 9 to 50. So you had over a 5-bagger if you timed it right. I think we're going to see that again because of the taper. I think prices on the metals will be low, probably could be through half the year, maybe even longer.
Yeah.
If the Fed really follows through with the rhetoric, they say they're going to do it. Show me, don't tell me. If they show me, I think you're going to see sideways prices in the metals, maybe slightly up, maybe slightly down. I think they're going to change a great deal from here. And then once that bottom's in and the Fed throws in the towel, then we're going to see the bottoms behind us, and we'll start seeing them move up, and I think rather strongly.
I remember that time last year. Around the same time this year, last year, 12 months ago, was the start of the silver squeeze. You and I had an interview, I remember on a Sunday night, right after the Globex opened. And, that interview you and I did happened to be number 17 on all of YouTube. It was trending. Like, everybody in the world wanted to know what was happening to silver at the time, and you happened to be, the spokesperson du jour. David, what's going on with premiums nowadays? Have they normalized according to your expectations, at least?
No, the premiums are still high in the retail market, and they have spilled over into the wholesale market as well. I mean, there used to be there was never a premium per se on a COMEX bar or a refined bar. I mean, basically it was spot plus middle pennies for paperwork, and then of course there were transportation costs depending who you were. But now there's actually a premium from almost anyone that refines silver on a 1,000-ounce bar. I'm not saying in absolutely every case, but on the COMEX, from the COMEX, there is.
Okay,
and that's unusual, and that actually suggests there's a tighter market than what the prices would indicate.
Okay, and so retail demand this year, up or down relative to last year, you think?
I think it'll be up because the stock market starts to sell off. The 10-year goes through the golden cross. We start to see more uncertainty in the market. And then if the cryptocurrency market starts to wane, we will see a lot more interest in the precious metals. And I believe all three of those things are synergistic to push the metals higher.
Okay, so we're going to talk about all those three things in just a minute. Just on the retail demand side for silver, is that really the most critical component when we talk about impacts on the price?
Yes and no. How do you like that answer?
Let's drill down on the yes, and then we'll go to the no, I guess.
So the biggest offtake of silver is industrial demand, and that's about 50%. Then you've got jewelry and silverware. And then on top of that, you've got monetary demand. And that's what drives the margin. So I've said many times, At an auction, the last bid is the one that gets the Ram Brand or whatever you're bidding on, the Tesla or whatever. So it's investment demand that drives the price higher. Now, we had record demand in 2020. Record demand. It was greater than industrial demand. I just said industrial demand is 50% of the market. Demand from investors, both institutional and retail, was greater than 50% of the market 2020. Is that true for 2021? The answer is I do not know yet. So the answer is it's not the biggest share of the market, but it's the biggest driver of the market. Will it be strong in 2022 remains to be determined. But as I said a moment ago, I think there's three factors that will come together synergistically to put a lot of people that probably never even thought of the precious metals into thinking about them and taking action.
Okay. Jesus, I've always imagined that your crystal ball will be made of silver. Yet to be determined. You have to show us one of these days. Okay, let's talk about, I want to go back to the stock markets first, because you kept saying that the stock markets might correct this year. First of all, just on today's action, in the last 5 days, I'm just looking at the graph here, in the last 5 days, the S&P 500 has corrected 4% already, which is significant for a weekly move. Now, for the S&P 500, you stated that usually in a market crash, gold and silver tend to sell off with equities. Now, we're not seeing gold and silver selling off just yet. So does that imply then that we're not really yet in a market crash?
Well, good observation. You can look at it two ways. One, my famous saying is one day doesn't make a market. So we don't want to extrapolate too much. But again, it's a great observation. So we could be in a place where the holders of gold and silver are really, really strong hands. And the market could come back significantly enough and still not see gold and silver sell off like they normally do. The problem with gold and silver is that the gold and the silver markets, as they're known, are derivatives. They're not the actual physical reality. And because they're derivatives markets, you've got ETFs, you've got authorized participants that can leverage, you've got options, you've got all these things. I'm not saying they're right or wrong, I'm just saying the way the market works. And because of that, once the market sells off, usually the best holding assets in many cases are related to the precious metals. Mm-hmm. So they're sold off to meet margin calls or that type of thing. So I do expect the same if we get a large sell-off, but we might see less damage than we've seen in the past because, again, strong hands are holding the physical metal.
Right. And just on the market sell-off, why would stocks sell off even more this year? Is it because of the Fed or because of something else?
Yeah, well, interest rates play directly to the stock market, so that's part of the answer. The other part is the general market goes from an accumulation phase to a markup phase to a sell-off phase, or distribution is the better word. And we've seen the distribution going on for a long time. I've commented on it before. And what this is the insiders, the big names, the smart money start selling off their positions, but they can't sell off the positions all at once. It'll drive the market down. So as they accumulate slowly and don't move the market up, they distribute slowly to, let's say, less savvy investors so they don't drive the market down. That's taken place. You look at how many insiders, CEOs, and those types that have sold heavily into their stock positions and lightened them up. They're a great many. Lastly is the margin situation. Most investors are all in and then some, meaning they're on margin. So we're really in every classic top you can see. It is being distributed. The inside money's getting out, and this portends lower prices ahead. Plus the fundamentals. As I've said for years, there's no real tie between the fundamental economic situation and the price of these stocks.
Mm-hmm. Okay, yeah, fundamentals are overstretched for sure. Now, I don't think most people, I think, would agree with you on that point. The issue here is that they've been overstretched for a long time. And some would argue that the markets, the stock markets at least, do have the ability to withstand interest rate hikes. Would you agree or disagree with that statement?
Both. It depends if the Fed lightens up enough and we go into a Zimbabwe situation. I mean, the Zimbabwe stock market was the best in the world a couple of years ago. Why? Because so much funding money was created and people try the best to protect themselves, so they go in the stock market rather than holding cash. And could that happen in the United States stock market? It's possible. I don't think it will, but we've certainly seen that tendency so far. Yeah. I mean, the market's had a huge put, or I should say the Fed has had a huge put on the market. and all these money managers, pension funds, insurance companies, they all know this. So they go into the market with a kind of a cavalier attitude that it can only go up.
Right.
So if they go to MMT, modern money theory, forget raising interest rates, the taper's off, we've got to save the economy and print even more, then I could see the stock market just going into the point where there's no return, meaning that some place, as Von Mises stated, the crack up boom will take hold and people say, well, geez, I got $1 million, but it's not worth anything.
Let's just talk about the crack up boom. Yeah, that's an important point. Fed policy is dependent on two things, well, many things, but their dual mandate states that they have to monitor inflation and full employment. So let's focus on the inflation side. Where do you see inflation headed? We're already at the highest levels since the 80s.
Yeah, I see it higher. I know I can make an argument on both sides. I think it's going to be price driven or supply driven on the food side, which there's massive issues. Supply chain, of course. And then I think just the untrust of government totally across the board, not just in the U.S., but basically worldwide. There's been a trust breakdown. The connection between government promises and reality have been broken across the board. So this is going to cause people more and more. And they really concentrate. Most people don't know what the stock market is, let alone invest in it. But they know how much they pay for gas and they know how much they pay for bread. So they're going to equate that to inflation. Even though it could be caused by a shortage, they're going to see it as higher prices. They say that's inflation. They're going to think, what can I do? I've got the savings. I'm going to buy more food and store it away. I've got a little bit more. I think I'll put it into fill in the blank, probably precious metals as time wears on.
Yeah, it's too bad canned food can't be a commodity to trade. You buy some canned food last year, you store it, a year later it goes up double in price, you sell it to your neighbors. I'm afraid that's not really a market that I can participate in, unfortunately. But let's talk about markets we can participate in. One of them is cryptocurrencies. That market has seen tremendous sell-off, or selling pressure rather, over the last couple of weeks. Now, the Bitcoin, fun fact I read this morning, Bitcoin has seen the worst start of the year out of any year since its inception. How about that, David? What's going on?
Touche, David. I did not know that. Thank you for bringing it to our attention. Well, first, I want to state that I really thought when the cryptocurrency phenomena started that it did draw away a lot of funds that might have gone into the precious metals. But I didn't take it as seriously as I should have, because there's been a great deal of money that's gone into the cryptocurrency sector that could have or might have gone into the precious metal. Of course, I could say it could have gone into the bond market, doubtful. Could have gone into stocks, that's more likely. But a lot of it would have gone for safety and anonymity that a lot of crypto investors want. They want that privacy, that DeFi, and that type of thing. So we've seen that, and I'm of the ilk that there's something awry in the Bitcoin world. And I know I get a lot of haters because I don't understand Bitcoin. Believe me, I probably understand it more than most. But the main thing I said in my article, my 2 bits about Bitcoin in 2014, so over 7 years ago, is look at the money powers. I said, don't care what I care about Bitcoin. Make up your own darn mind. The market will know more than me, and the market will decide if it's worth something or not. And if the market decides Bitcoin's the best thing on the block, and it has been for a long time, then the money powers are going to have a problem. Well, I just did an interview on my Crypto Conspiracy Series, number 14, with Kurt Wuckert, and he explained how basically the master charge empire has hijacked BTC. And I don't have time to go into the details, but it didn't surprise me to learn that. And so now, if you think you're in a place where you're independent, anonymous, you got a decentralized currency, Bitcoin's the best thing on the map and all that, you better rethink it, because who's running it? Basically the MasterCard group.